All right, let's just jump right into it. Today, we're unpacking an explainer on what is gearing up to be the largest initial public offering in human history, the SpaceX IPO. But look, there is a massive hidden story here, and as you'll see, it goes way, way beyond just rockets. 1.75 trillion with a T. That is the record-shattering valuation SpaceX is reportedly targeting right now. Just to put that astronomical number into perspective for a second, that makes it worth more than every single American defense contractor combined. You could lump together the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks, and SpaceX is still bigger. Heck, it's worth more than the top 10 companies on the entire London Stock Exchange combined. It's absolutely massive. But here is the wild part. The stark contrast to that financial reality is that last year, this consolidated company actually lost, wait for it, nearly $5 billion, all on roughly $18.5 billion in revenue. So that mind-boggling juxtaposition right there begs the central mystery of our explainer today. Who on earth is buying a company that's bleeding $5 billion a year at the largest IPO valuation in history? And maybe more importantly, why? Well, as you're going to see, the answer might actually be you. Okay, Section 1, 3 businesses in one. Let's look beyond the rockets. Breaking down that $18.5 billion in total revenue actually reveals something pretty surprising. Those famous rockets we all see on the news, they make up a really small slice of the pie, only about 25%. So to really grasp this trillion-dollar valuation, we've got to look at the rest of the business, the good, the bad, and, well, the ugly. Let's start with the absolute cash strain, xAI. Founded back in 2023 to take on OpenAI, SpaceX ended up acquiring it in an all-stock deal that valued it at $250 billion. But right now, it basically functions as a massive financial black hole. We're talking about lighting roughly $1 billion a month on fire. I mean, sure, that's a very impressive campfire, but it is a brutally tough business model. And to top it all off, by March, every single one of its 11 original co-founders had literally walked out the door. And honestly, it is pretty staggering to see how massively overvalued xAI is relative to its estimated revenue, especially when you stack it up against the industry heavyweights. Take a look at this comparison. You've got OpenAI generating about $24 billion a year with an $850 billion valuation. Anthropic is doing $30 billion in revenue, valued at $400 billion. And then there's xAI. They're estimating just $1 billion in revenue, but were bought for $250 billion. It essentially acts as the piece of SpaceX that just burns through whatever cash the rest of the business manages to scrape together. Moving right along to the rockets themselves. You know, the famous public face of SpaceX, the side-launching satellites, running NASA missions, hauling cargo. They actually generated a totally respectable $4 billion in revenue last year. But here's the thing. While $4 billion sounds great, it is absolutely nowhere near enough to justify a near $2 trillion price tag for the whole company. So here is the crucial takeaway. The real crown jewel, the part actually paying the bills here, is Starlink. Think of it as this insanely efficient satellite internet provider. It's kind of like Comcast in space, though, hopefully with slightly better customer service. They launched in beta back in 2020 and have just exploded to over 10 million active subscribers. For 2025, Starlink alone brought in $11.4 billion in revenue. But the really crazy part is the efficiency. Their profit margins have rocketed from 41% 2 years ago to a staggering 63% today. And they are expanding like wildfire across consumer, aviation, maritime, and defense sectors. All right, moving on to Section 2, the NASDAQ rule changes. Let's talk about manufactured demand. Now, right before this IPO, the NASDAQ very quietly adopted a brand new fast entry rule. It used to be that a newly listed company had to wait at least 3 whole months to be added to the NASDAQ 100, giving the market some actual time to figure out what the true price should be. But this new rule, it drastically compresses the wait time for passive index funds down from 3 months to just 15 trading days. They are quite literally squeezing 3 months of organic price discovery into a 3-week window. On top of that, there used to be a strict minimum free float requirement to join the index. Basically, a company needed to have at least 10% of its shares available for the public to trade. Well, the NASDAQ just completely eliminated that mandatory 10% minimum. which is incredibly convenient, considering it allows SpaceX to qualify for the index with their tiny targeted float of just 4 to 5%. I mean, just 6 months ago, that would have been an instant automatic disqualification. But here is the absolute wildest part. Buried deep in all that technical jargon is a hidden multiplier rule. This means that for companies with a float under 20%, ETFs are now legally required to treat that tiny float as if it were 3 times larger. Yep, you heard that right. So SpaceX's 4% float gets weighted by the index as if it were 12%. It is essentially a loophole to artificially manufacture massive, automatic demand from passive funds. So what does this all mean for us? Well, these highly tailored changes essentially roll out the red carpet. They are completely rewriting the financial rules, completely swapping out organic price discovery for perfectly manufactured demand. And listen, this isn't just about SpaceX. This clears the runway for a whole incoming class of tech giants like OpenAI and Anthropic, who are almost certainly going to list with this exact same setup. Which brings us to our final part, Section 3, your 401k, the exit liquidity. Now, normally, a standard IPO will allocate a pretty small fraction of shares to retail investors, usually around 5 to 10%. But SpaceX, they are targeting an absolutely unprecedented 30%. Their CFO reportedly told bankers this was just to reward retail buyers who've been quote-unquote supportive. But if we translate that out of corporate speak for a second, it means the largest IPO in human history is explicitly designed to dump a massive amount of supply directly onto the general public. It perfectly encapsulates the stark warning from portfolio manager George Noble. Your 401k is the exit liquidity. The whole structure here is beautifully designed so that the buyers and the sellers don't actually show up to the party at the same time. The insiders who are sitting on these low-cost shares get to unlock their stock much later, while retail investors and their retirement accounts are forced to jump in early and absorb all those shares right at peak valuation. And this right here is what we call the passive trap. Because SpaceX is getting that immediate NASDAQ 100 inclusion, and because there are over $600 billion in investment products that blindly track that index, the mechanics of passive investing are just going to automatically kick in. The system is basically going to take your retirement funds and use them to buy this massive cash burn of a stock, a mashed up company that, remember, lost $5 billion last year. And it's going to do it completely without your input. So, I want to leave you with this final, really crucial thought to consider today. For years, passive investing has been sold to us as this brilliant, low-fee, set-and-forget strategy. But the exact feature that makes it so incredibly convenient, it also turns you into a guaranteed forced buyer for absolutely anyone who manages to quietly squeeze their way into the index. So you've got to ask yourself, does the ease of passive investing really justify giving up your choice in what you're actually buying? It is absolutely a question worth asking the next time you log in to check that retirement account. Thanks for joining me on this explainer, and as always, keep questioning what's beneath the surface.